So guys, today we're going to be looking at a scalping trading strategy that I'll be outlining using the 15 minutes chart and the 1 minute chart. So before we even go into the strategy or the example, I'm going to outline the framework that we'll be using. So this is the framework that we'll be using on the 1 minute chart. So in this example, we have a higher time frame order block of a value gap that has been hit. So when we talk about higher time frame in this perspective, because we're talking about scalping, this could be, in this instance, it's the 15 minutes order block of a value gap that has been hit, or it could even be a 1 hour order block of a value gap. Apart from that, it could be a sell side liquidity or a buy side liquidity that has been taken out. So in this instance, we are seeing that the market was coming up, so it was driving higher. So this is a bearish example. So the market was initially driving higher, then it fails to hit that order block of a value gap, then starts to move slightly away, and then you see the market now drive higher into that order block of a value gap. So this is a point in price that you are anticipating the market could potentially be turning. So you're anticipating this point could potentially turn the market to the downside, and then so the market, once it hits that, now you go to the 1 minute. So in this framework, this is a framework on the 1 minute. So this pattern you'll be looking for in the 1 minute chart. So apart from that, we're seeing that there's a buy side high. This high here was taken out as it hits that high time frame order block. So once it hits that and it takes out this liquidity, the next thing you want to see the market now reject that level aggressively. So this is your confirmation that this market is likely to drop to sell side liquidity, or rather it is likely to drop lower into lower targets. So the confirmation that you need is this aggressive move, and this move should typically leave an imbalance. That's why I've indicated here a value gap, and it should also break market structure. So market structure is broken once this short-term low is broken. So this short-term low could be in the 1 minute. It is broken. Then now you don't chase price on this move. You wait now for price to come back to you. So this price will typically come back and retest this area that it broke structure, and you will couple that with a fair value gap or an order block. So it will either be a fair value gap or an order block. So sometimes the market can go deeper into an order block that was left here. So we all know that an order block is the last. For instance, in a bearish scenario like this one, the order block will be the last up close candle in this price, maybe in this section here. That's where your order block will be. So the market could reach as high as that. But typically I like to use the fair value gap because it's the clearest. It's so clear, it's just there. So you use that, and then once it hits that fair value gap, that's your entry. So you take that entry. But guys, it's not just an entry that you take just because the market has come to the fair value gap. It's an entry that you take. Now look at this. This is the most important aspect of this strategy. So even though you're scalping, but you want to be doing high probability scalping, so the time factor is going to add the probability of that trade setup. So London session or New York session, that is when you want to be hunting for this entry and for this pattern. So if it is not within these two kill zones, don't anticipate this setup to be fruitful or to be high probability. It could pan out, but it's not high probability. So when the time, so I'm talking about the London session and New York session, the way Michael teaches. So you can check out ICT's YouTube channel to learn more about the time sessions that I'm referring to. But typically the London session and the New York session is just the period between, for instance, for London, it's between 2 a.m. to 5 a.m. New York time, which is UTC. And New York session is 8 a.m. to 11 a.m. New York time. So once you enter here, you want to exit your positions on sell side liquidity. For instance, this is one of the example of a sell side liquidity, and then there could be another sell side liquidity in this area. So your stop loss will come above this high, and then even for the bullish scenario, it's just the same thing. Your stop loss comes below this low, and then you want to see this impulsive move away from that level. Once it fell short and then it took out those sell side, this move here is the confirmation now for us to hunt for buy opportunity. So you also target buy side liquidity during London or New York session. That's very important, guys. So that's the key to high probability scalping. So let's look at an example or two. So when you look at this example, we'll start on the higher time frame perspective as we'll be defining in this example. So this higher time frame perspective will be even a 1 hour chart or even a daily chart if you are day trading and you're looking for 15 minutes. But in this example, since you're doing scalping, we'll be focusing on the 15 minutes and the 1 minute chart. So in this example, we are seeing that this was 30th December 2022. So in this example, we are seeing that the market actually it hit a daily order block here, but we're not going to be focusing on that for now. So after you've seen the market maybe make this impulsive move, and we still have buy side liquidity here, the market comes down to this imbalance. Actually, I did not outline this, but this is a good example that you can go and check out in the 1 minute. But I'll be doing just these examples here. There's this example on the order block and this example here. But this is also a good example of how the market now turns from this region to go to that target. So you can drop into the 1 minute and maybe study that. So, but today we'll be looking at this price action once it took out that sell buy side. It came back down all the way to this level. So this is a level we're watching for prices to potentially go higher because already the market was bullish on the daily chart. So, but guys, you do not need the daily bias in order to trade this strategy. I'm just mentioning because that's what I was trading that time. So there's another block here that you could be watching as a potential. So guys, the beauty of this strategy is that you don't need to know the daily bias, first of all, and you don't need to know whether the market will react on this order block or not when it is coming down. So look at how aggressive it was coming down. So majority of the traders will not be thinking of buying when this market was coming down here. For sure, majority will not be thinking of buying. But we do not consider this price action as a roadblock. So once the market gets here, hits that order block, that is when our interest now comes in. Because now we are anticipating this market to turn at this point. So there's an imbalance, there's an order block, so there's probability and this time factor. So it is New York time. It is at 30 a.m. New York Killzone. So your entry will be taken. Typically your entry should be taken here, but you do not want to be entering a market that you're not sure if it will come and take out this order block and this loss. So that's why we drop into the 1 minute. So let's drop into the 1 minute. We'll also be looking at this example. Once it took out this high, it drove lower to retest another order block right there. So this market was already still going higher. So we'll be looking at that example also on at 10:45 a.m. So let's go into the 1 minute and see how it went. So actually in the 1 minute, so this is the example I was telling you about, although it did not form the kind of structure we're looking for, but I've done another video. I think I explained how there are only two ways that the market turns. So even looking at this was, although they did not take out this low, once they broke this high here, this is an entry right there, but that's for another day. So in this example, let's look at the first example. So when looking at this chart, this is the 1 minute chart. So this is the 15 minutes order block that was hit. So once it hits that, so this is where I was telling you it falls short right there. So you can see how it falls short of that order block, then starts to rally, then digs deeper, hits the order block. So you do not enter once it hits it. You wait. You wait for the market to confirm that now it wants to run away from that level. So look at how aggressive it runs away, leaving an imbalance. So actually this imbalance is what you should be considering for your entry. But sometimes the market doesn't really come back down because this is the 1 minute chart and the 15 minutes it's aggressively going higher. Sometimes it might not come back to fill that imbalance. But once you see that imbalance and the break in structure, I will recommend that you do not enter when it's high. For instance, you do not enter up here. That's not a very good entry because it's already moving. But you can wait maybe for any down movement and you just take your entry. For instance, this candle here was a good opportunity for, because it was just consolidating and it already confirmed that it wanted to move higher. Then you take your entry on that candle you can, if you are waiting for it to come back down here, then you'll have missed that entry. So, but I'm not saying that you always be looking like this. Sometimes it gives you a very clear entry where it comes back to the balance, then it goes higher. But in this instance, we'll be using this candle as our entry. Then once you enter, place your stop down below that low. So your stop comes below that low. Actually, guys, if you check it out, that is about, if you enter right there, it was about just 12, around 12 pips. So if you look at now the target, the first target, actually, when you enter here, you're going to be looking at the buy side liquidity. So we had this target, and the final target was up there. So guys, actually in this strategy, very important, you want to be aiming for 15 to 20 pips. That is what I've found to be high probability, and that I think will be a very good objective. So for instance, in this example, let's look at how it went. So if you look at that logic, maybe entry right there. So let's put our entry right there. Our stop loss comes in right there. So we'll be aiming for this buy side. So that's already 2.5 R. This was 12 pips. We are getting 31 pips above here. But I've told you, 15 to 20 pips is high probability. So guys, even before it got up here, even at this target, you're already booking 30 pips. So that's how powerful this strategy is. So guys, I'll recommend that you go back to your charts, back test, look at just 15 minutes order block in an intraday perspective, or even the 1 hour order block. Look at how it is hit, and then once it is hit, what happens? Look at the response. So that's response is your confirmation that this market is likely to go higher. So the other example that I was to show was this one. We had another order block here. So it was a bit choppy because of time, because we are looking at around 11, it's already 11, but it still gave us that entry. We still had liquidity above here, which had left, it had left at around 940. So that was a good target. We also had this buy side right here. So this was the buy side you should be targeting when considering an entry here. So we see that the market actually, if you had taken this entry right there, so let's say once it broke market structure here, that is your entry. Look at how precise it comes to that imbalance, then it starts running away from that. So you'll be taking an entry around there. Your stop loss should be down there. So you're targeting 15 to 20 pips, so 25 pips above that high, and you're aiming. So that's about, I think I drew the wrong, should have taken the long position, but yeah, let's do the long position so that you can see that multiple. So it's about there. We have about 12 pips stop loss, so that is 15 pips above those highs, and then above that high is about 25-ish. If you aim for the highest high, that's about 30 pips. So guys, that's what this strategy is all about. So the most important aspect of the strategy, like I've told you, is time. So maybe you can outline the most important things about the strategy is time. Don't forget about that. We have this impulsive move once it hits that, and then we have the structure formation. If we will go back, you want to see this structure. So in this instance, for instance, once it came to hit, so that's a bullish scenario. So it fell short, then starts to rally, then comes and hits it, then we break structure. So this move is important, and also this aspect where it falls short. Like for this instance, we see it drove lower, though it hit and then started going, but came deeper, then started running higher. So that's all about this strategy. Guys, go back and backtest. This is a very powerful strategy. If you're into scalping, it will be a very nice strategy to add to your basket. Thank you so much. Thanks for watching. Thank you so much, guys, for watching. I hope this video has been helpful. If you enjoyed this video, don't forget to like, subscribe, and comment. Also, let me know what kind of content you want to see or any suggestions you have. Thank you.